Hi, it's Dre Griggs of Obsidian Wisdom. Today we answer the question, why is the US dollar dropping? And this is one of those questions, if you woke up this morning and you were looking at the stock market is going down. Again, we're looking at numbers and we're saying that we're at around 100-year lows, that the market has not had as bad of a month of April as it had since the Great Depression. So there's a lot of feelings out there. And one of those little weird tidbits is you're like, wait a minute. It says that the dollar is also dropping in value. So today we'll talk about just what that means. You guys know I love economics. Talk about what that ultimately means as far as your investments in your future and why it is something to keep an eye on when you're talking about the overall economy and the feelings in general. So today we'll go over 4 things that are kind of impacting the value of the dollar and what we would do for our retirement investments, things that we would be concerned about, and then we'll move forward from there. So what I'm going to do is I'm going to share my whiteboard with you and we'll go over the 4. So first and foremost, as you would imagine, it's the elephant in the room. So we're going to talk about the tariffs. And then when you talk about the tariffs, you're basically talking about the trade war. 2, we're going to talk about the pressure on the Federal Reserve. So if you've been listening to some of the comments that the president has been making to the Fed, then you're already going to be able to have an idea. And we'll talk a little bit about that and how that impacts the value of the dollar and why it's decreasing it as well. Number 3, we'll talk about just regular good old loss of confidence, just how people feel about the United States of America. And so we're going to talk about just our overall economic leadership and how that can impact the value of the dollar and the increasing or decreasing of it. And then number 4, it has to do with what we call economic alternatives. And all we're talking about is the price of gold. So these are going to be the 4 things that we'll use to explain why the value of the dollar is dropping and what that would mean for your investments in your retirement income. So let's go through each of these. So first and foremost, let's start with tariffs and the trade war. So when you're talking about inflation, there's 4 main things that cause inflation. And I'll give you an example of each of them, and I think that'll help you out as well. So number 1 is called demand pull inflation. Demand pull is what we just went through when you're talking about COVID-19, where there was so much demand, so much desire to buy toilet paper and hand sanitizer that the price of those items exponentially increased. Because there was so much demand for it, everybody wanted those items. That causes the price to go up, which is a form of inflation. Number 2 is going to be cost pull inflation. So cost pull inflation, this would be everything from, hey, I need lumber to build a house, and for whatever reason, the price of lumber has gone up. You could think of Waffle House, where the price of eggs have gone up, so Waffle House charges more for their eggs. But in this particular environment, your cost pull also includes things like the tariffs. We understand that the goal of the tariffs on the one end, the positive end, is to bring back manufacturing in the United States. We also recognize on the negative end, it increased the cost of those items when they're normally imported to the United States. The idea is, if I'm able to raise the cost of those items, then people will either A, move their manufacturing to the United States so they can lower their prices, or B, the Americans will have too high priced items, so they're going to choose the American product because the American product is going to be either the same or possibly lower once you include the tariffs. So you have cost pull inflation. Number 3 is what we call the wage cost spiral. The idea is, if I give a raise to my employees because they're like, hey, the price of eggs has gone up a lot, I think I need a raise to cover the price of eggs. But then that is a cost for your business. That is an increase in your cost of goods sold. So what are you likely to do? You're likely to increase the cost of your item in the market. So an example of this could be if I have to pay people, instead of $5 an hour, I pay them $15 an hour. Well, I have to figure out a way to cover that extra $10 cost. Generally speaking, I'm going to raise my prices. If my employees cost more, then my item has to cost more. And so that is the 3rd form of inflation. And then the 4th is what we call excessive money printing. In good old-fashioned economics, this is pretty straightforward. Something is more valuable the scarcer or the fewer seats that we have. So think of the Super Bowl. There are maybe 40,000 seats in the stadium, but I think we all recognize that there are more than 40,000 people who want to go to the Super Bowl. And because there's more than that, that means that there is a bidding war. People want to get their seats and they're willing to pay extra for it. So you could buy the item and resell it. If you're not a big sports fan, then think of Black Friday items. There is maybe 5 items that are half off, and there's a long line of people interested in getting that item. That scarcity, or the fewer items made, it increases the value of it because more people want it than is available, which means the opposite is also true. If you're printing a whole bunch of dollars, as we have been, $38 trillion in debt, that ultimately means that there is an excess of this item. There's so much of it that I don't even think twice about it. It's not as valuable because I can get that tomorrow, I can get it the next day, I can get it in 5 years. It's always going to be there. Think of that more like the jersey for your favorite team. They'll just print more jerseys. There is no issue. However many jerseys you want, that's how many you get. You would like your currency to be closer to the limited number of Super Bowl tickets than the unlimited number of jerseys that can be printed. Now, when you're taking a look at these items, you can say, all right, in this current economic environment, if you're saying that these things are all a part of why the value of the dollar is going down, I don't really understand how it's connected. Well, let's go through some of these items. So we're talking about the tariff and the trade war and how that impacts the cost pull. All we're saying is that your money has to be worth less, not worthless, but worth less, because I have to pay more to get the same item. I know that I would go to Chick-fil-A, and in the past 5 years, I would get the little 30-piece nugget platter. I think it was maybe $12.99, and that was maybe 5 years ago. And the price was so good that it was like, if you got a 5 or 10 count, it was maybe $8, $9. And I was like, dude, we might as well just go ahead and get the 30 count. And so we did. Well, a couple years later, that price went up to $17.99. And then this last month, the price was $21.99. So I'm sitting there like, well, wait a minute. If the price keeps going up, that means I need to spend more money to get the same product, which means that my money is worth less. That at one point in time, when I pulled my calculator out, that I was able to get 30 nuggets for $12.99. And if I do $12.99 divided by 30, that meant that each nugget was 43 cents. Hey, feeling kind of good about that. But at the current price of $21.99, that means now that each nugget is worth 73 cents. So you can see that means that they're saying that the nugget has almost doubled in value to my dollar. And I know that sounds a little crazy, and it does, but you get the math and what we're talking about. So when we talk about that, we talk about tariffs and the trade war. If I'm increasing the price of the items, I am saying that your dollar is worth less. Your dollar cannot purchase the same items that it used to purchase. Then when you move on to the pressure of the Fed, what we have been seeing is the president has been saying, hey, I need you to lower the interest rates, Fed. And the Fed has been like, no, we're not going to lower the interest rates. Sorry about that. And one of the concerns of that is it could lead to hyperinflation. That would be a huge concern when you're talking about the value of a dollar. In other words, you have kind of one of 3 concerns. One is you think the Fed chair is going to say, you know what, the president wants this, I'm going to go ahead and lower interest rates. That would be a huge concern. Number 2 is the president's going to try to fire the Fed chair and then replace him with someone that is going to say yes to lowering interest rates. And then concern number 3 is the chairman of the Fed only gets a 10-year term. Fun fact, it was President Trump who nominated Chairman Powell during his first term. And so when President Trump placed Powell as the chair of the Fed, that was in 2016, which means worst case scenario, his term is going to end in 2026, which means it's going to end in a year from now, which ultimately means that if the market is concerned that Trump is going to elect someone who's just going to do what he says, that is going to cause economic concerns. Now, let's go through it because you're probably saying, well, I don't know what the big deal is. If interest rates are lower, it's going to stimulate the economy. More people are going to buy houses. More people can have money for loans in their businesses and things like that. And while that is true, there is a dance. So the Fed always has 2 goals, and they're contradicting goals. The Fed's goal, right? So they have the Fed goal. So goal number 1, low unemployment. And goal number 2, low inflation. And the main thing that they do is they adjust the interest rate to achieve those goals. So let's go through how that would look. So these are our economic seasons, right? So this is our economic cycles. We have increases that we would call expansion. and we have decreases that we would call a recession. And so if you remember back when we had really high inflation, what was going on? There was a handful of events going on. So when we had high inflation, number one, everybody had stimulus checks. So we had a lot of money in the market. Okay, excessive money printing, check. We had a whole lot of costs going up because we had the supply chain issues. You remember during COVID, everything was kind of bogged down. We couldn't get the supplies in. There's a lot of ports that were closing and different lockdowns and different measures that were put in place. It was really hard to get the items. We had the truck drivers and we're doing all this stuff. We had emergency workers. You remember, it was kind of a little weird time. Well, we also had the wage cost spiral. Because we had such low unemployment, we had to be super competitive to get someone to leave their job, right? Just right now, just think amongst yourself. If you have a job, what would be the minimum salary you would accept to get a new job? And let's say you like your job. And then if I said you have no job, what would be the minimum salary you would accept? And I think we both agree that the minimum salary I would accept is going to be lower if I don't have a job. Well, if everyone has a job, I may have to offer you something like 20% increase to what you're currently making. So we had the third form of inflation in that particular point in time. Now, the interesting thing that we had was there was also demand pull inflation. You may or may not remember, but do you remember when people were buying houses and people were just paying $100,000 over asking price? Do you remember that? People were just like, you know what? I have the money and I want the house. I got the raise and I want the house. And they didn't care how many people bid on that house. And so they were going way over asking price because people were like, I'm going to get that house. Interest rates are low. Money is high. Everybody's getting raises. We were living La Vida Loca. Okay, that is called, right, economic growth and expansion. The issue with leaving interest rates low when all of this is happening is you already see it. It creates super high inflation, which is what we had. Do you remember that 40-year high of inflation? So what did the Fed do? I'm glad you asked. The Fed said, okay, I know that our goal is low unemployment, but right now everybody has a job and it's just crazy out there. People are just spending money like there's no tomorrow. So we have to cool this market down. How do you cool the market down? How do you lower inflation? I'm running out of space on that side, so I'll place it over here. You increase the interest rates. Because if you don't increase the interest rates, we would just keep going up. Everybody would keep bidding crazy amounts of money on these houses. Everyone would keep getting new jobs, the 24% increases from the last jobs, and we would have the shelves still being empty. It would still go, and that is called hyperinflation, where it just keeps going up, 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 and up. So the Fed will increase the interest rate. So they said, okay, if you had a 3% mortgage, we're going to raise it to where the mortgage is 7%. And there's a couple things that happens here. One is all of a sudden your new house isn't as sexy. And now it causes you to have a much higher monthly payment for a much smaller house. That's a real decision that people have to make. And as you notice, it cooled down the real estate market almost overnight, just by doubling the interest rate. People are like, I don't know if I want to move anymore. And so now the inventory starts kind of cooling down. Everybody's like, I'm not moving. I'm not interested. Obviously, we're kind of exaggerating in the sense that nobody moved. Obviously, still people had to move, but there's much fewer houses on the market. That then lowered the demand. So we started getting rid of the demand pool. We started lowering the demand. And then that started lowering some of the prices of the homes. We then, because you have higher interest rates, now money is more expensive for not just you buying your home, but for businesses looking to grow and expand. So businesses started cutting their R&D, which is research and development. They stopped acquiring other businesses because the money wasn't as profitable for them. And when you start doing that, what do you end up doing? You start laying people off, which is what happened. We saw tens of thousands of people starting to get laid off from their position. When you get laid off, we just already talked about it. What do you end up doing? You accept a new job at a lower rate because you'd rather have something than nothing. And so now we start seeing there's this decrease in demand. There's a decrease in the amount of money people are starting to be offered. You start seeing the market to cool down. And so that's what they end up doing. That is how you round it off. That's called the peak. And then as we start slowly decreasing, which is what we've been doing as the interest rate were higher, the Fed last year started lowering the interest rates just a little bit, nothing too crazy. They don't want to accidentally lower it too much and throw it back into the hyperinflation route, but they started lowering it a little bit. So you notice your interest rates went down to 6% on the home. And then you're probably seeing some at 5%, and you may have even seen some a little bit in the mid 4%. And then the Fed stopped right there. So the past Fed meetings, they said, we're just holding right here. We don't think we're quite in a recession yet, and we don't think we're quite out of the woods yet. So when the president says, I want the Fed to lower interest rates because it's going to stimulate the economy, while that is true, the concern is it's going to turn us back, and then we're going to go up back into the hyperinflation, where the average price of a home right now went from $200,000 to like $450,000. That's a big shift, especially if you're a Gen Z and you're coming out of the market and you're like, I don't know how I'm going to get a home because my wages didn't go up that much. And so that's why the Fed has been holding. And so if someone does get elected that's just going to do what the president says, economically speaking, the concern is that if that's going to happen where you go back to hyperinflation, then our money is going to be worth even less. Not worth less, but worth even less. And so that is the second concern, because there's going to be a new chairman of the Fed next year. We don't know how independent the Fed is going to be, but high level, it's supposed to be very independent because they can't just leave the rates low because that's what's going to happen. Just think back to what we just went through. That is how the economy works. We have the same 4 cycles, just like the regular seasons. We have spring, followed by summer, followed by fall, followed by winter. Those are always the same 4 seasons. In economics, you have expansion, or we would say growth. Then you have the peak. And then you have the decline. And then you have the trough. That's the bottom. So that is always the same 4 cycles. And at some point, we'll hit the very bottom of the recession and the Feds will lower the interest rates to stimulate growth again. And then you go back into growth. And then at some point, they're going to lower it and it goes back to peak. Those are the 4 seasons. That's how it works. We don't get to decide, I want to have 2 summers this year. That's not how economics works. As a result, a lot of people are saying, if this is true, if what the president is going to do is elect someone that's going to lower the rates before we're 100% sure they need to be lowered, just to stimulate the economy in the short term, it's 100% going to create a bubble. You can think back to any time the government starts doing things for these weird reasons, it always creates a bubble because the economy is going to adjust. Oh, well, if you're going to give us free money, I'm going to take the free money and I'm going to invest it. I'm going to grow and then I'm going to pay people because the money is free. Who cares? I'm going to make a great return on my investment. And then we're going to find ourselves in that weird environment where we talk about excessive money printing and we're going to be in hyperinflation. At a minimum, it will be inflation. But if you start putting all these together where people are making more, you're printing extra money, you have the tariffs, and then you have people with the money, so they're demanding these items, it's going to be a very rough time for the dollar because the dollar's value is going to continue decreasing. As it takes more money to buy those nuggets from Chick-fil-A, that means that I am decreasing the value of my dollar because I'm increasing the value of the nuggets. And that sort of led us into number 3 without me explicitly saying it, but that is why the concern is on the economic leadership. Economically speaking, we know the seasons of the economy, and the seasons are the seasons. We don't get to just change them for any random reason. So if that is what's going to happen, we all know what that ultimately means. And that's why the value of the dollar has gone down to maybe a last 5-year low. Because if this is true, the dollar is going to be worth less. And then number 4 is the price of gold has been skyrocketing. I believe the price of gold, I believe I saw it today, it was at $3,500, which is an all-time high. That's absolutely crazy. And so if you get an ounce of gold for $3,500, that is basically the economy saying, if I had 2 choices to hold gold or a dollar, I would rather store the value of my money with gold. And because there is concern about the value of the dollar, when you leave the dollar, that's where you're generally going to go. You're going to go to gold. And so we see that if gold is increasing in value, that makes it more attractive to hold your money. If the value of a dollar is decreasing in value, that makes it less attractive to hold your money. Think back to when the sanctions first started happening with Russia, everybody was selling the rubies because the rubies weren't holding value. And because we're sort of getting in that weird spot, now the dollar isn't holding value compared to other currencies. And that concern is not going to go away when you talk about these 4 levers. Now, as far as what you can do, the way I normally look at it, I'm going to share an option with you. You can see that this is called the Golden Butterfly Portfolio. I actually like this portfolio a lot. It has a lot of the elements of the permanent portfolio that we talk about, but it's not as conservative. And so it gives you the opportunity to still leverage a lot of the growth, but you are also protecting yourself against some of the losses in this market in particular. And what you can see here is this particular allocation has 20% in large caps. And we talk about large caps, that's normally going to be companies that are over $10 billion. We talk about small caps, and only be companies about $100 million to about $2 billion. And then when you talk about long-term bonds, that's probably going to be at least over 10 years, but not uncommon to be 20 to 30. And then short-term bonds are normally going to be under 2 years. And then gold is gold. So we don't have to talk about gold anymore. And so this is actually one of those allocations that does perform pretty well in this economic climate because, as always, I have a position that is going to perform well in all these environments that we're talking about. And what you can see here is you can see between 1970 to 2024, this particular allocation has averaged 6%. And so that means we have the COVID in there, we have 9/11 in there, the dot-com bubble, we have the Great Recession, we have the oil crisis, we have all of that in there. And you can see that we were able to maintain about a 6% return in all of those markets. You made money 84% of the time. You can see that the loss was less than 10%, about 15% of the time. And it was a very rare, but it did happen where your loss was 10 to 20%. And so you can see that. You see an average about 6% the majority of the time, but you did make over 10%, 10 to 20%, about 25% of the time. And then you even made more than 20%. You can see that was maybe about 5% of the time. These are just different variations of how to read the numbers. But right here, it tells you what particular year that you lost the money. So we can see the oil crisis caused a small loss. Then you can go through and be like, okay, what was going on at that particular time? And then you can talk about the different issues that we're adjusting for. But you can see that overall, it was able to maintain its growth and protect you from the downside. Because it's not that the goal is to make money when everyone's losing money, because that can't happen. But a lot of times it's to limit the losses. So if the market is losing 30% and I lost 10%, I would consider that a win. Because the way our diversification worked is we were not all in on predicting a recession. We were hedging the risk of a recession, but we're also allowing ourselves to participate in the economic growth as well. And so normally when you're talking about this, this is what I would normally recommend for someone. If you're worried about the economic volatility, then it only makes sense to pick an investment strategy that allows you to win in a variety of economic climates, because the reality is that's where we're at. That any given month, there could be a complete shift in the market. So I'm not going to be chasing the news cycle. I'm just going to allocate my strategy right now. So I might be getting stocks for a discount. I might be overpaying for gold, but because it's my overall asset portfolio, it will then give me the opportunity to participate in the growth when the stocks rebound. And I also have the hedge against future concerns, whether it's stagnation, inflation, and all these other environments. Because right now, the Fed's number one concern is stagnation, right? Stagnant economy because there's so much uncertainty. So I'm not sure what to do. Companies have been laying people off. They haven't been hiring people. There are people that aren't sure whether they should change the logistics, whether they should outsource something, or whether they should build a manufacturing plant in the United States. Because high level, we have 90-day pauses, and there's just a lot of uncertainty. So I don't know what I should do. And there are stories of different people, and I tell you all the time, economics is someone's winning and someone's losing. It's not that everyone's winning or that everyone's losing. It's that someone is winning and someone is losing. There is a strategy that works in each climate. And because of that, a lot of people are just not sure what strategy they should implement. Are we going into a winter? Are we going into a spring? I don't know what the season's going to look like economically. Are we going to go down into the recession, or are we going to move up into hyperinflation? It is a different approach that you would have to take. Currently, having an allocation that at least protects you from both of those is probably going to be the best approach for anyone that's talking about their retirement investment. Now, if you're talking about just money that you gamble with, the money to grow with, then we can have a strategy where we try to be very aggressive. But if you're talking about your retirement, you don't want to play with your retirement money. The goal is to get rich once and to stay rich and not have to build your wealth again. If you're someone who found value in this video, but you're not 100% sure what your next step should be, inside of the link in the description, you can book a complimentary appointment, and we can put an investment strategy together for you to ensure that you're well protected for this year and into the future as you prepare for your retirement. As always, I'm thankful for our time together. I do not take it for granted. If you found value in this video, go ahead and hit the like and subscribe button so you can continue to receive valuable insights on how to create your own wealthy retirement system. Until next time, stay safe and enjoy life.